Hello and thanks for joining me for today's session. That's the accounting and finance coaching sessions. I am your coach, Echela Okori. Today I want us to look at strategic financial management. What is strategic financial management? As a course, strategic financial management looks at various topics, but essentially it is the strategic decisions of an entity. That is the long run decisions of an entity in the direction of which it wants to go. Which direction does it want to go in the long run? What is it looking at? Where does it see itself in the long run? And then we're looking at the role of financial management in making it come to pass. That is in investment decisions, that is in risk management, that is in growth, that is also in dividend decisions. What kind of dividends do you want to pay your shareholders? Do you want to pay them dividends? Are they dividend-oriented shareholders? And you are interested in making sure you pay them dividend every other year? Or are they shareholders who are interested in wealth maximization, such that when you bring about the appreciation in the market value of their shares, they are contented? So you could do expansion, you could bring about growth of the entity, and then the market value, the market price of the shares of your entity will increase on the stock exchange. And then this will bring about an appreciation in the value of their shares. So essentially, strategic financial management has to do with how you source for funds for the day-to-day running of the entity in the short run and also in the long run. And when you have surpluses because you've met your working capital needs, what do you do with the surpluses of finance? Cash surpluses, what do you do with them? How do you invest them? Or when you have deficits, how do you source for funds? How do you strike a balance between your equity and the debt? That's the borrowing. In other words, how do you balance your capital structure to ensure that it is not high geared or not low geared? You have a good balance. Sometimes also, it is more beneficial to the entity to use more debt than equity. At other times, equity is more beneficial. So, all of these decisions, the dividends you pay, the investments you make, how you balance your risk, how you do a good portfolio management so that all your investments are not put in one basket, but the risks are diversified away. So all of this collectively is under the purview of the course called Strategic Financial Management. Today, I want us to look at investment appraisal. Investment appraisal is a very interesting topic, and you may want to ask, why do we need to appraise our investments? We need to appraise investments because it's a way of managing risk. Sometimes you don't have, in fact, all the time, funds are never enough. The capital requirement for investment can never be enough because there are always limiting factors. And where you have those limiting factors, you have to make decisions. So if you have a project, we'll call it Project A, for instance, and this Project A requires an amount of money, you need to calculate. Is it going to be worth it? Is it going to be worth doing? You have a capital outlay that will bring about this project. What are you going to gain? What will be the cash flows that you are going to benefit from investing in this project? So you need to do an appraisal to know whether the project is viable, whether it is feasible, and most importantly, whether you are going to be better off for it. So usually in investment appraisal, we look at forecasted cash flows and we also look at forecasted inflows. So the outflow is usually at the beginning, but during the year also, the various years following, you could also have some cash outflows, but basically it is usually the cash inflows that we look at in the subsequent years. Now we have various techniques for investment appraisal. We are going to look at the payback period. We are going to look at the accounting rate of return. We are going to look at the net present value, and we're also going to look at the internal. Good. Now let's begin by looking at the payback period. The payback period is very easy to understand, and that is actually one of the advantages. It is easy to calculate and it is easy to understand. Now, what is the payback period? The payback period is essentially the period it will take an entity to recoup the amount expended on its investment. In other words, in fact, let's illustrate with an example. You have a project that has been identified by the entity. Let's call the project Project A. Project A may be investment in a machinery. Perhaps you want to buy a machinery, or you want to build a road, or you want to build a toll gate, whatever it is. Let's call it Project A. Now, there is what we call the initial capital outlay. That is a capital requirement to invest in Project A. And let's say this initial outlay is 10 million naira. Now, if we say 10 million naira is required to invest in Project A, whatever it is, whether it's a purchase of a machinery or a transformer, for instance, or building of a toll gate, we have identified that 10 million naira is required to invest in Project A. Now, the organization will carry out an investment appraisal by looking at the forecasted cash flows. So, we will now say year zero is 10 million naira. Year zero is what we usually call the year in which the capital outlay is spent. In other words, we're saying now, as at now, before we begin to get any cash flow. This is what we require, so it is year zero. That's the year of the capital expenditure. That is the year of the initial outlay, which we have identified to be year zero and to be 10 million naira. Now, let's say by some actuarial design, we are able to get some forecasted cash flows. We can get the net cash flows. Net cash flow is cash inflow, money coming into the entity, less cash outflow, money going out, money is being spent out of the entity. When you net it, what you have is what we call the net cash flow. So for payback period, we are looking at the net cash flows. Now for year one, let's say for year one, we are expecting the sum of 2 million naira. Let's say for year two, we're expecting the sum of 4 million naira. Let's say for year three, we're expecting the sum of 6 million naira. Now, for this kind of example, the payback period is very simple to understand. It's very simple also to calculate. So, we said is the period that it takes to recoup the money spent on the investment, which is 10 million naira. So, we want to see how fast the 10 million naira will pay back itself. So for year one, we have 2 million. That is 2 plus. Year two, we have 4. That is 4 plus. Year three, we have 6. So you have 2 plus 4. That is 6. And then, okay, before I do that example, let me say this is 4. Let's make this 4 so that it doesn't get complicated from the beginning. Now, if we say this is 4, and let's also say that we have, this is year 3 and this is year 4. Therefore, we say we have 6 million. Okay, now, so if we say year 1, you have 2 million naira. Year 2, you have 4. 2 plus 4, that is already giving us how much? That is giving us 6. And then when you add 4, you have 10. 10 million. So 2 plus 4 gives us 10. So in this year, this is the payback period. So that is what? Year 3. Payback period is equal to 3 years. So the payback period is 3 years. In other words, it means that in 3 years' time, we are going to recoup the amount of 10 million naira invested. What is the decision rule for a simple example like this? The decision rule is that if the payback period, the maximum payback period set by this entity is less than 3 years or exactly 3 years, it will be accepted. But if the payback period, the maximum payback period set by the organization is 4 or 5 years, it will also be accepted. But if it is 2 years and the payback period is 3 years, it will be rejected. I want you to understand what I'm saying. Come with me. Payback period set by the organization is said to be 2 years. Calculated payback period is said to be 3 years. Will you accept it? Of course not. You won't accept it because it means the payback period calculated has failed to meet the set target of the entity. So in this case, it will be rejected. So for every project, there is a set payback period, or some organization might have their own policy that this is their payback period for all of their projects. So where that happens, then they follow it strictly. Let me play with this example. We'll play with the example and then we'll see. Now, let's say that this is not 4 and rather this is 6. If this were to be 6, what does it mean? It means for year 1 we have 2 plus year 2 we have 4. 2 plus 4 is already 6. If you get to year 3, you add 6 plus 6, you have 12. This is already more than 10. You have exceeded your payback period, so it doesn't work that way. So we'll say 2 plus 4, we have 6 already. If you move to year 3, you have more than your payback period. So you identify 2 years plus what is left to get our 10 million naira. We are looking for 4 million naira. So that will be 4 million naira all over 6 million naira. So let's do this. I hope you can see that. That is, we're saying 2 years plus 4 million out of 6 million multiplied by the 12 months we have. Okay? Now if you say 6 year 1, 6 year is 2. 4 times 2 will give us 8. That means your answer is 2 years, 8 months. Now that is the payback period. So the payback period will be 2 years and 8 months. So if the target payback period that is set by the entity is under this, if it is less than this period or exactly 2 and 8, then it can be accepted. So the decision rule is that if the calculated payback period happens before or at exactly the payback period set by the organization, the maximum payback period set by the organization, you accept. So if the payback period set by the organization is 4 years and what you calculated is 5 years, you cannot accept it. You reject the project. Now, basically, the payback period It's simple to understand, it's simple to calculate. In an exam situation, the examiner may decide to play with the question just to make it a bit professional, to make it a bit complex, especially as it relates to real life situations. What are the things that could happen? Let me give you the guide. You could have something like a scrap value. If there's a scrap value at the end of a project, you add it to the last year. If they say in year 5 there's scrap value, that is your cash out. Cash inflow is also an inflow. A scrap value is an inflow. The first thing for you to know, for every item that comes in any of these years, you need to define whether it is an inflow or whether it is an outflow. If you have an inflow in this year, which is 6 million here, and you have a scrap value or whatever it is you have, there's additional information. You need to identify whether it is an inflow or an outflow. If it is an inflow, you add it to the existing inflow. For example, you have 2 million naira as scrap value at the end of the period. It means that 2 million naira will be added to the 6 million naira to get your cash flow. That's the net cash flow for this year. If you are told that in year 4, they are going to pay back something that has to do, maybe a liability that has to do with this project in year 6, it means it is an outflow. In that case, you will less it from 6 million naira. That will give you the net cash flow. Basically, that is what can happen with your payback period. So at this point, I want to say that payback period is a very simple one. It's simple method of appraising project. So what are the advantages? An organization that is interested in liquidity, you want to know how fast you will get your money back. The best method for you to use in appraising your project is a payback period, because it tells you how soon, the earliest time that you will get back the money, at which you recoup the money invested in the project. It is also simple to calculate. It is simple to understand, but it has lots of disadvantages. Okay? It doesn't make use of cash flows. It makes use of net cash flows. That is a disadvantage. Another thing that is the most important disadvantage is that it does not consider, it does not take into cognizance the time value of money. And what is the time value of money? The time value of money simply says 1 naira today is worth much more than 1 naira tomorrow. Why? Because there is risk, because there is inflation, because there is uncertainty. Yes. And for all you, my students, I want to tell you, always be cognizant of the time value of money. Always remember to take out your money at the earliest possible time and invest it in a project that will give you returns, better returns. If you have maybe you work in an organization and then for the period of January to December, you are at liberty to choose any month and get out your leave allowance, for instance. I'll tell you, get it out at the earliest possible time and invest it. You will get better returns, because 1 naira today is worth more than 1 naira tomorrow. If you are in a contribution where people contribute money and give to people, if you have the opportunity, every other person is not interested because they want to show they are rich. If you have the opportunity, get your money, be the first to get your money, because you could, let me tell you, if you are buying cement, for instance, you could buy cement in January, maybe at 5,000 naira, and by December, when your colleague is taking theirs, you'll be shocked that the price of cement is no longer 5,000 but 10,000 naira. So who has gained? That is the simplest example I can do for you to understand the time value of money. So the payback period does not consider the time value of money. It does not discount the cash flows. It doesn't. It just uses them like that. It says net cash flow. And it doesn't consider that something could have happened. There could be risk. There could be uncertainty. There could be inflation. It doesn't consider all of this. So that is that with the payback period. And we'll move quickly to the accounting rate of return. Let's look at an example of the accounting rate of return.